In 2002, at a 90th birthday party for legendary economist Milton Friedman, a sitting governor of the Federal Reserve walked up to the microphone and did the unthinkable. He looked the man in the eye and confessed to the greatest economic crime in American history. He said, "Regarding the Great Depression, you're right. We did it. We're very sorry. But thanks to you, we won't do it again." The man speaking was Bernanke, who would soon become the chair of the most powerful financial institution on Earth. But how does a single agency do a Great Depression? How does an institution that isn't technically a government department, yet isn't exactly a private company, hold the power to evaporate the life savings of millions or trigger a global recovery with the click of a button? Today, we go inside the machine. This is the mechanics and the mandates of the Federal Reserve. To understand why the Fed exists, you have to understand the chaos that came before it. In the 1800s, the US was a financial Wild West. There was no central bank to regulate the flow of money. Instead, you had thousands of private banks issuing their own banknotes, basically their own versions of the dollar. Some were good, some were unrelievedly bad. If a bank made risky loans and couldn't pay its depositors, it failed. And because there was no lender of last resort, one bank failure could trigger a scramble or a financial panic that paralyzed the entire country. The system was broken. In 1893, a massive depression rocked the nation. In 1907, another panic nearly collapsed the entire U.S. economy. It was only saved when J.P. Morgan, a private banker, personally assembled a coalition to intervene. Wall Street realized it couldn't rely on ad hoc rescues forever. They needed a system. But there was a problem. Americans hated the idea of a central bank. They saw it as a giant monster that would give a few elite men gigantic financial power over everyone else. The story of how the Fed was born sounds like a conspiracy thriller because, in some ways, it was. In 1910, a group of Wall Street bankers and Senator Nelson Aldrich snuck away to Jekyll Island, Georgia, to draft a secret plan for a new central bank. Aldrich was a pillar of the Eastern establishment, and the public deeply mistrusted him. His plan called for a National Reserve Association, controlled almost entirely by bankers. The progressives, led by William Jennings Bryan, were horrified. Bryan argued that if the big bankers were in control, they would own the nation's finances completely. The result was a tenuous political compromise signed into law by President Woodrow Wilson on December 23, 1913. Wilson wanted a decentralized structure under public control. The bankers wanted a centralized one under their control. What we got was a hybrid. A board of governors in D.C., which is a federal agency, and 12 regional Federal Reserve banks scattered across the country, which are organized like private corporations. But here is the first revelation that most people get wrong. Who owns the Fed? The regional banks issue stock to the private commercial banks in their district. This makes it look like the Fed is privately owned. But this ownership is largely a fiction or symbolic. These member banks can't sell the stock, they don't get the profits, which go to the U.S. Treasury, and they don't get voting rights proportional to their size. It is, as critics call it, a self-perpetuating oligarchy that exists in a gray area between the government and the market. So, how does this machine actually control your life? It has three primary tools. First, the federal funds rate. This is the interest rate you hear about in the news. It's the rate banks charge each other for overnight loans. When the Fed lowers this rate, it's called easing. Borrowing becomes cheaper for you, for your car, your house, your credit cards, and the economy speeds up. When they raise it, it's called tightening. Everything gets more expensive, spending slows down, and inflation hopefully drops. Second, open market operations. This is where the Fed buys or sells U.S. government bonds. If they want to pump money into the system, they buy bonds with newly printed money. If they want to pull money out, they sell them. Third, the discount window. This is the Fed's role as the lender of last resort. If a bank is healthy but suddenly runs out of cash because of a panic, it can go to the window and borrow directly from the Federal. This is designed to stop a single bank failure from turning into a nationwide collapse. But in 2008, the Fed realized these tools weren't enough. They turned to a non-traditional policy called Quantitative Easing, or QE. They started buying hundreds of billions of dollars in mortgage-backed securities and treasuries to thaw the frozen credit markets. Critics, like Ron Paul, called this creating money out of thin air. The Fed isn't just playing with numbers for fun. Congress gave them a dual mandate: maximum employment and price stability. Imagine a scale. On one side, you want everyone who wants a job to have one. On the other side, you want a gallon of milk to cost roughly the same next year as it does today. The problem? These two goals often fight each other. If the Fed keeps interest rates too low to help people get jobs, it can trigger a spike in inflation. If they raise rates too high to kill inflation, they might cause a recession and put millions out of work. Economists used to believe in the divine coincidence, the idea that if you just stabilized prices, the labor market would take care of itself. But as we saw in 2021, that coincidence can break down spectacularly. This brings us to the key insight most people miss. The Fed is often its own worst enemy. Critics like Milton Friedman and Murray Rothbard argued that instead of stabilizing the economy, the Fed actually creates booms and busts. Take the Great Depression. Friedman and Schwartz argued that the Fed actually choked the money supply after the 1929 crash, refusing to save banks and turning a mild recession into a great contraction. Take the 2008 financial crisis. Some economists argue the Fed kept interest rates too low for too long after the 2001 recession, which fueled the housing bubble that eventually exploded. Take the COVID-19 pandemic. The Fed grew the M2 money supply at a historically high rate and kept rates near zero until 2022. The result? Inflation peaked at 9.1%, a 40-year high. The Fed's own stopgo policies, alternating between being too restrictive and too expansionary, have often produced a toxic mix of high inflation and high unemployment. Why should you care about a bunch of economists meeting 8 times a year in a marble building? Because their decisions are the invisible hand in your pocket. They decide what you pay for your mortgage. They decide if your business can afford to hire you. They even decide the value of the dollar in your bank account. In 2020, the Fed tried a new experiment called average inflation targeting. They basically said they would let inflation run above 2% for a while to make up for times it was too low. Critics called this a damaging step backwards, with an inflationary bias. By 2025, they had to abandon it and return to the basics of the 2012 strategy. Your life, your savings, and your future are the laboratory for these shifting strategies. So the real story isn't just about interest rates or bank reserves. It's about how a century-old political compromise has become the most powerful and most criticized engine in the global economy. It is an institution that can apologize for the Great Depression while simultaneously being accused of causing the next great crisis. And as this story continues to unfold, one question remains. In their attempt to manage the dual mandate, is the Fed a stabilizer of the system or the primary cause of its instability? What happens next?